Think positive. Never show any sign of weakness. Always go for the throat. Buy low, sell high. Fear, that's the other guy's problem. Nothing you have ever experienced can prepare you for the unbridled carnage you're about to witness. Right. Super Bowl, the World Series, they don't know what pressure is. In this building, it's either kill or be killed. Right. You make no friends in the pits and you take no prisoners.
Good idea. It's the execution that isn't.
Well, you know what they say. Bulls make money, bears make money, and the pigs, they get slaughtered.
Guys, thanks for your patience. Again, my name is Josh Asher. We're going to go ahead and get this thing started. It is about 2:05 Eastern Standard Time. So, again, just want to thank everybody for your time. I know it's very valuable. This is the first of a series that we're going to be doing, really just trying to educate our clients and stakeholders and research subscribers on the risks in the marketplace. Here at TAM Portfolios, we believe a lot in transparency and education and communication to the clientele. So we're going to be doing these monthly. Any suggestions that you guys have after going through this, please let us know. You can shoot us an email or just type into the chat section any suggestions you guys have. Real quick, a couple logistical things before we get going. This webinar is put on by TAM Portfolios. We've got a guest presenter here today from Tesseract Asset Management. And just so everybody's clear, Tesseract Asset Management is the parent company of TAM Portfolios. So as such, TAM Portfolios is a wholly owned subsidiary of Tesseract Asset Management. Tesseract Asset Management provides market commentary, newsletters, research, those types of things to TAM Portfolios. And TAM Portfolios is a registered investment advisory firm that provides portfolio management to advisors and institutions. We have SMA products. We've got 3 of them. You guys will see them here today. We're on the Charles Schwab platform, and we're in process on getting up on the UMA marketplace over at PlaceMart. One final thing before I turn it over to Kevin and Rocket to kind of get you guys going. Everybody be on the lookout. We're publishing a book, 100-Year Market Theory. Is something that we originally came out with back in 2003, and it is really about the evolution of risk in the marketplace. Should be available on Amazon by about the middle of January. So kind of be on the lookout for it. You can type in Kevin Tuttle's name in the author list, or just obviously if you're a member on our research, you'll kind of see it coming. But very unique perspective on the market, and it really has been our North Star. It is our investment philosophy. So I think a lot of people will like it. Get out there. Check it out, and if you guys have any questions, of course, give us a call. So kind of how we're going to structure these conference calls and these portfolio meetings on a monthly basis moving forward is just going to be, we're going to bring Kevin on, who's the chief strategist with Tesseract Asset Management. He's going to really kind of talk about some really high-level things, risk in the marketplace, some geopolitical and fundamental factors that could possibly affect the markets, where the risk is at. And then we're going to turn it over to our portfolio manager, Josh Welch, who is commonly referred to here in the office as Rocket Man. And we refer to him as that because he used to build rockets at Lockheed Martin. And we picked him up over there, and he does a lot of our quantitative algorithms and that kind of thing. So after Kevin goes through and gives you guys a high-level kind of look on the risk outlook of the market, Rocket is going to take you through the portfolios and the performance. So without further ado, I guess I will turn this over to Kevin Tuttle. And if you guys at any time throughout the presentation have any challenges with the audio or visual, just type in the chat section. We will be monitoring it, and we'll try to reach out to you and get it fixed. So I'll turn it over to you, Kev.
Thank you, Josh. I appreciate it, and I appreciate having the opportunity to be involved and be on these calls with TAM Portfolios. It's pretty exciting, the dynamics. We've spent the last 2 decades building up our research subscribers through the internet and our email base, and now with the advent of webinars and what we can potentially do to keep up the transparency with both what's happening in the market and with also our portfolios, it's exciting to be able to deliver this to you. And again, as Josh mentioned earlier, if there's anything that we'd like to see changed as we move forward, we'll be more than happy to put those in place. So I'm going to go ahead and get us started here and walk into the through the portfolio. One of the things that I'd like to talk about as we get going, first of all, this is the agenda. You can see that Josh made the introduction. We have the market outlook, which I'll be covering. Then I'm going to turn it over to Rocket, and he's going to go through the 3 portfolios which focus on our ETF managed strategies, and then we're going to sum it up and hopefully open it up to any question and answers that are out there in the field. When we look at the landscape of which we're dealing with right now and really where the market is heading, the only picture that comes to mind is this one. And that is the wind beneath my wings versus the sand beneath my foundation. And what we're talking about here is really where the market is in a general stance, where it has been, not only over the last 5 years, but really what's transpired here in 2013 thus far. What we're going to do, though, is break down why there's so much wind beneath the wings of the market, and also what are the underlying problems that we see or challenges that the market will have, and that's the sand washing away beneath the foundation. So we're going to start with that, and I'm just going to give you a preview on our thought process of what's going on with the Fed and also what is transpiring underneath the surface of the marketplace that is causing some concern that we wanted to tell you as our market commentary subscribers and portfolio managers that are on here, as well as the people that are invested with us, to let us know really where we stand. And I'm going to start out with a broad overview of some of the commentary and really put together a compilation of the charts and the research that we've been putting out since the beginning of the year and how we derive that. We're a fusion analysis shop, so we look at not only the technical moves of the market and the fundamental, but also the behavioral aspects, and we run that through our quantitative algorithms. And where we start with the behavioral is something very simple, as you can see here, is the Michigan Consumer Sentiment. Now, as you know, this report comes out and has been coming out for a multitude of years, and what I'm showing you here is the underlying, the blue chart, is the Michigan Consumer Sentiment going back to the year 2000. The black, as you can tell, is the S&P 500 from 2000 until 2013. The challenge that we're having is that every time that the market goes up to a higher high, the sentiment is less and less during this period of time, and that's awful concerning. We believe that consumer sentiment obviously drives the behavioral patterns, will drive retail sales and therefore GDP and therefore the economy, therefore employment, so forth and so on. And this is what we believe to be the birth or the beginning of some of the troubles that we're seeing in the marketplace. When we move on, we look at it and say, okay, if we're getting a generational gap or a generational decline in consumer sentiment, what is that doing and how is that affecting what's transpiring in the market today? And what we have, as you can see, this is a FRED chart. FRED stands for Federal Reserve Economic Data, and they produce these. It's a great area where you can go and find this information. It's very user-friendly, and you can pull this anytime you want. But what I pulled today is real final sales of domestic products. So really what you're looking for, or what you're looking at, is GDP on an annualized growth rate adjusted for inflation. And as you can see, as you drop below that 2.5% threshold, the gray lines and the gray areas is every time we've had a recession since 1950. And the great recession that we had here in 2009, you've seen this recovery, but the recovery barely breached that 2.5% growth that we'd like to see to have sustainability of any kind of economic upturn. And now you're starting to see it come back down again. And this is very disheartening and concerning because this is some of the sand, again, that's washing away the foundation behind the market. This, right now, you can say, well, how do you find that in actual hard numbers? How do you quantify it? And one of the things we're going to look at here is you can see that the U.S. retail sales year-over-year growth, you can lay that again over the S&P 500, and again you will find these divergence zones in the 07 period, in the 2000 period, and again here in the 2013 period. When you have a divergence in your retail sales, which is the driver behind gross domestic product, you can see that there was a 6-month lag here, and then the market had a downturn. That was the tech bubble. With the real estate bubble, the divergence lasted a little longer. You saw a divergence of the stock market. Retail sales started to decline much greater period before you saw the S&P decline. This is about an 18-month period. And here lately, now you're going on 2 to 2.5 years where you've had this divergence. And this, again, underlying, showing that where is this growth coming from? And really that's what we have to answer today. In the last 9 months, our firm, Tesseract Asset Management, in the market commentaries that we've been putting out, both in our quarterly reports and the Morning Cup of Joe, has been outlining another divergence, and that is the fact that you're seeing S&P earnings growth, but you're not seeing S&P revenue growth. So you're seeing bottom line, but you're not seeing top line. Up here you can see that on an annualized basis, you can see the percent growth that has been positive all but 2 quarters during 2012. And even though you're getting some positive revenue growth, you are getting declining revenue growth during this period of time. So what is it indicating? It's indicating financial engineering. So we've talked about retail sales. We've talked about consumer confidence. We've talked about GDP on a real basis. So how are we still getting that earnings growth without revenue? And that's, again, the manufacture of those earnings through whether they be stock buybacks. I mean, even this morning, if you look at it, Johnson Controls announced that they're going to be buying back an additional $3 billion of their own stock. And obviously, you know, corporations like Apple, you're finding them do the same thing. So if they have less stock on the marketplace, obviously the earnings per share will be increasing. Those are some of the things that corporations do. This, in turn, if you're walking down the path, will lead into employment. So if retail sales were up and GDP was expanding, you would see you would see unemployment rate start to decline even faster. Now, as we all know, the Fed has been talking about 6.5% on the unemployment rate before they start tapering. Now, obviously, there's a lot of whispers going around with Bernanke and the next meeting, which will be coming up in December, which will be his last meeting, and Janet Yellen, who is talking about, when she first came out, mentioned that she would pretty much have quantitative easing to the year 2020 if she could. But yet they snuck out some minutes yesterday, that were saying, well, just because we pull back on the tapering doesn't mean that we're still not pumping money into the system. Instead of 85 billion pumping in, we could be pumping in 65 or 75 billion. So they're trying to prep the market. The rule today is everybody's anticipating that, okay, now that they've kicked that can so far down the road, March will be the period of time when they're going to stop tapering. And what does that mean to us? So one of the things, and I'll find it somewhat humorous, there was an article that came out in the Wall Street Journal November 11, 2013, in an op-ed by Andrew, and forgive me if I don't pronounce this right, Huszar, and he was a trader that got hired for the Fed to actually instigate and buy the trillions of dollars through the quantitative easing one, and calling it the largest farce that he's ever been involved with, and he wrote an apologetic letter to the American public, and I would suggest reading. It's rather humorous, yet also scary. This chart, what I'm showing you here, is the effect. This is the wind beneath our wings. This is where and why the market is where it is today. What you're seeing is the Federal Reserve total asset growth in the blue, with the S&P 500 laid over the top. What we've also shown is the periods of time that there was quantitative easing, what happened when the quantitative easing shut off, then the quantitative easing got turned back on, so forth and so on over this period of time. And in the last 5 years, there's been a few events, and there's been obviously quite a bit of quantitative easing. When they shut that off here, you can see the divergence where the Fed's balance sheet went flat and the market came down. As soon as they shut it off, 2 months later, you had the flash crash in 2010. The market corrected nearly 18%. Then all of a sudden they said, well, it's not over yet. Let's go ahead and turn the quantitative easing 2 on. They turned that on, and when that got turned off, the Greece debacle took over, and we saw this break in the S&P 500 in August of 2011. And during that period of time, we had a 21% downturn in the S&P. Then they decided, well, that's definitely not enough. Let's put a program in place called the Twist. Now, if you'll notice here, the asset growth of the Fed did not expand during this time, slightly, but did not expand greatly. And the reason for that is because it was a Twist program where they were moving long money to short money. So you didn't see an expansion of the balance sheet. When that was over, we had, as everybody remembers, a year ago today, the budget sequester problems, and we saw a decline in the market. This was somewhat less. It was only approximately a 12% decline, and then they decided at that point to put quantitative easing 3 to infinity and beyond in place. The last, as you can see, the last little hiccup that we had was May 22nd in the Fed taper meeting, and this is important here because this is where Bernanke first came out and said, hey, by the way, it looks like we may start to taper. And it really spooked the market because everybody does understand this chart of what I'm showing you right now. If you look at a correlation metric, when you go back over the last 5 years, the amount of asset growth from the Federal Reserve is an 88.7% correlation to the growth of the S&P 500 during that period of time. It is a statistical truth. This is not an anomaly. It is not a facsimile. This is exactly what is driving the marketplace. You will look at companies today like Target, who came out and said, by the way, we reported a decline in earnings. You've heard Walmart already warning on those earnings. This is the first driver of those retail sales. Now, I'm not trying to scare you. I'm not trying to tell you that the market's going to collapse. What I am telling you is that if and when the Fed decides to stop feeding the system, the economy has to stand on its own. For that to do that, you're going to have to see a greater GDP. We're talking about a fourth quarter GDP of this year potentially coming in at 1.4%. Let me say that again, 1.4%. That is not enough. If the Fed stays in place, then the market should remain stable, unforeseen any other circumstances. There are things out in the market today on a global basis, whether it's China and the revamp of their monetary system, whether it's the inflation or the lack of inflation that we're seeing in Europe, which is now causing a major concern because you don't want them to go into a deflationary period, or whether it be something of the nature of Iran and the troubles that we're having over there right now. Now, these are things that are on the horizon. They're not affecting us today. But these are the possibilities of what could affect the market in the future. What I'm going to do now is this is really a broad scope and a summation of what we believe to be the effects of what's changing the market's landscape. Over the next 45 days, we anticipate that there probably will be little, if any, trouble in the market unless, again, an unforeseen event does occur. The next thing that we're concerned about is the fact that we believe that there will be another government shutdown going into January because there's only so many times you can kick this can. And as everybody knows, nobody in the Senate is out there trying to solve this. They're going to wait to the last minute. They're going to go on their holidays, and they're going to come back, and we're going to have the same scenario again. So tapering and another potential shutdown is really the only things that we see on the horizon for any hiccups. So this melt-up of what you're seeing in the market may potentially last through or up until the area around Christmas. Now, with the Bernanke's meeting coming out in mid-December, there's going to be a little bit of vacillation. They tried to put some warning shots across the bow yesterday saying that taper doesn't mean that they're going to turn it off or they're going to start raising rates. They just said the taper word. So again, the market has been driven by this philosophy, and the pendulum apexes are very, very high. As we've mentioned before, there's been a lot of recessions based on gross domestic product not coming in, or retail sales, or even consumer confidence not coming in where it has to be. If Obamacare has any play in this and there is a taxation issue going into next year, that's just one more log that they're going to throw onto this economic fire. However, corporate balance sheets look better than they ever have, and the reason for that is that they've been pumped with so much money, but they don't know what to do with it. And the only reason that they don't is because they don't have the confidence behind it. If that does change, we will look rosy going forward, and that should lend to an increasing top-line revenue growth, not just the manufactured earnings growth that you're seeing today. So, again, I hate to leave it at this, but to say that we're sitting on the fence, but as Rocket, as Josh Welsh will soon tell you, go with the flow, and the flow is up. The trend is up, and the warning signs are out there. The sand is washing away beneath the foundation, yet it's being held up by a large and vast amount of money flow. So, Josh, I'm going to go ahead and turn it back over to you.
Okay, thanks. Awesome. All right, I'm going to go ahead and just dive into the portfolio overview and just kind of give you a brief snapshot of where we are, how the portfolios are allocated, and where we see the potentials possibly shifting going into year's end and into the first quarter. So the first portfolio I want to discuss is Sage, and I'm going to go ahead and bring you to our webpage, which has all of our product information, and this includes our monthly performance reports as well as what we call trade rationale sheets. And real quick, just on the trade rationale, just to take a moment to discuss that, we, like Asher was saying, Josh was saying at the beginning of the presentation, we firmly believe in transparency with our clients and our investors, and part of that is we do what we call trade rationale reports every time there is a allocation shift. So at any time, if you're ever curious as to why we have a certain position in our portfolio for whatever reason, you can go back through in our archive and click on these reports and see the decisions and what was going on at the time that we made that and why it's in the portfolio. So with that being said, I'm going to go ahead and jump into performance report for October in Sage. And real quick, just to kind of tie in what Kevin was saying earlier, there's fundamental weakness, and there's a lot of evidence out there that does not support, besides the quantitative easing, does not support these current levels. Manufactured earnings, he talked about consumer sentiment, just doesn't, it's not matching up. And part of the way that we alleviate some of that confusion is we use what we call the CTI, which is our underlying technical indicator that helps us dictate when these cyclical shifts in the markets are, and these shifts are based on the 1 to 4 year business cycles that occur. We're currently in the 5th year of a 1 to 4 year business cycle, so we are at the end of one of these potential moves. But again, the question is how much longer is it going to keep lasting. As long as QE is in place, that's a question mark there. So part of the way that we alleviate that is just what we call the CTI, and it's a proprietary indicator that we've developed that helps us dictate where those shifts are. And so again, it alleviates some of that subjectivity and gives us more of a quantitative approach to know when to shift our portfolios, regardless of market fundamentals or any rationale. So just real quick, I want to point out our market stance. We're in a bullish state, and again, just citing some of those fundamental issues, we're right between bull neutral and bull. I'm going to go down here and just talk about one of the main points of Sage. And part of the strategy is we want to capture the upside growth in these cyclical bull markets while minimizing the volatility. And you can see here, this chart here shows that we're 72% of the volatility of the S&P. So we're capturing the meat of this move, but we're taking 72% of the volatility. So we're achieving an objective on that end. I'm going to go to the back sheet here. This is the second page. It shows you where the portfolio is allocated. And I'm just going to highlight the top two allocations. We have a 30% allocation in the SPDRs and the VTI, and this is our market general exposure. This helps us, again, capture the meat of that move. The second top position we have is the healthcare and banking. Those are the two top. And again, these are just positions that we've seen that have a higher relative strength. There's other metrics that we look at to dictate how those are weighted, but those are top performing, and that's just kind of a brief overview of where we're currently allocated. One thing I want to point out is one of the really good strong selling points of this portfolio is the fact that we have the ability to, within 24 hours, we can we can reduce exposure if we feel that there's an event in the marketplace that is dictating, along with the CTI, dictating some sort of shift to reduce our market stance. Oh, sorry, got out of the PowerPoint. To reduce our market stance. So that's a really good thing that we have control over. And again, that's a 24-hour time frame that we have to reduce that exposure. So I'm going to go ahead and so that's Sage. I'm going to go ahead and jump to our next portfolio. Oh, I lied. I'm going to talk about a couple of opportunities we have that could transpire into some shifts in the portfolio. Again, these are just things that we're seeing that could transpire into a shift. Doesn't mean it's going to happen tomorrow or next week, but again, as things transpire in the marketplace and we see certain sectors come in and out of favor with investors and relative strength pick up and decrease, it calls for the need to sometimes shift our allocations. And so these are just some of the things that, two opportunities I'm seeing that that could dictate one of those shifts. The first one is in C, and this is an international shipper, and its primary product, or the companies that are within this ETF, its primary product that ships is natural gas, and there's a natural gas boom along with a shale boom in the U.S. that we're seeing right now. And we've talked about this before in the past, but this is really driving some growth in the industry. You can see there was a large sell-off 2010 through 2011, and you've seen some bottoming action here. There's a base that has been forming over the past since March of 2012 to now, and you've seen some buyers step in and really give some support to this area, and you can really see that there's some buying behind this, and this is very attractive to us. So what we're looking for on this is if our metrics dictate, and again it's quantitatively driven, fundamentally driven, if we see an indication to allocate, we will go ahead and we can add some exposure into this area. So this is something that we're seeing. The other thing that we're seeing, this is another one. This is XOP. It's a oil producers ETF, and we currently have a 15% exposure to energy. I didn't really touch on this a little bit, but I'll just go ahead and tell you now. We have a 15% exposure to energy. We believe that oil over the next 2 years, oil in the energy space in general is going to have a very large bullish opportunity, and so we want to take advantage of that. So like I said, we're 15% allocated, but like I was saying also, there are certain spaces within sectors that will come in and out of favor with investors, and by that I mean will have a higher relative strength than another position, and so what we're seeing here is there may be a possible increase of relative strength over another one of the energy portfolios that energy positions that we currently have. And if our metrics were to tell us that, hey, this is setting up right now, you got a good risk reward opportunity, we could see this as a possible replacement for, in particular, our USO position, which is the oil commodity itself. So that's something we're keeping our eye on. Again, there's some metrics that we're going to look at to dictate that shift, but those are some of the potential opportunities on the horizon. Okay, I'm going to jump into our next portfolio. This is BIG. This is our growth and income portfolio. And the first thing I want to state about BIG is that the time frame is is longer. It's than our other portfolio. It's 3 to 5 years, and the real meat and bones of this portfolio is realized by having a longer term time frame. And the reason why I bring that up is because you've seen a cooling off in the income space over the past 5 to 6 months, and this was caused by a knee-jerk reaction from the hint of tapering back in May. And I'm going to go ahead and pull this up real quick for you. So you saw this knee-jerk reaction, and what happened is they threw the baby out with the bathwater. So you saw the spike in interest rates, and anything that was associated with income got hit pretty hard. And like I said, it was a knee-jerk, but it doesn't necessarily mean there's anything fundamentally wrong in the space. And we firmly believe that. I mean, we keep our eyes open for fundamentals as well as technicals, like I was mentioning. So if there was something fundamentally wrong, we would definitely be the first to let you know, and we would make allocation adjustments accordingly. But as of right now, there really isn't. There's little to no fundamental deterioration in the income space. So with that being said, right now, BIG is giving the best opportunity for investors, and we feel for our clients, since the 2009 Great Recession bottom, all the way from a current yield standpoint just to a value standpoint. Right now, you're getting let me just zoom in so you can see it. You're getting a 5.6% current yield over the benchmark of 1.72%. And your volatility is a third of what the benchmark is. You're talking 2.1% versus a 5.7, just to give you some numbers here. And so you're really seeing the low volatility, the current yield, and that this growth chart over here is the kind of the final point I want to drive home with BIG. Is you saw in 2007 to 2008 when the portfolio was opened up, according to our backtest data, you saw we were able to strategically, tactically navigate that drawdown. And again, this portfolio is also based on our CTI that I was mentioning earlier. It is a driver, and it does dictate when we need to reduce exposure. And BIG being a growth and income, when there is a cyclical drawdown in the market, we want to get out of the way of that. And CTI in 2008 helped us get out of the way, button up our exposure, and then when the market shifted back to a cyclical goal at the beginning of the next cycle that began in early 2009, we were able to reallocate and go long again. And you can see that reflected in this chart here as there's a clear overperformance and big over the benchmark. The other thing I want to point out about big is it does have a couple positions that have tax benefits to it. So half of the positions, two of them in particular, the municipals and the master limited partnerships. I won't dive into it too much, but there are some tax benefits that go with that make it very attractive, especially when you're getting drawdowns, or I'm sorry, not drawdowns, but you're getting these panic sell-offs, these knee-jerk reactions that create these opportunities. When there's really nothing wrong, especially in the master limited partnership space. There's nothing wrong with that space. It just happens to be associated income, so people will panic at that. So that's big. That's probably the biggest selling point of big. Is just that this is the best opportunity since the 2009 bottom. You're getting that value. You're getting the current yield, and you're getting that lower volatility. So I'm going to go ahead and jump and go to our final portfolio, and that's Pulse. And Pulse is the one I like to call the rocket fuel portfolio, and it's not just because my nickname is Rocket. It's because it's a high octane portfolio. And again, the third product, it is also centered on the CTI, and it's probably the most correlated to the CTI shifts of all of our products. And what I mean by that is that it is 100% in the market at all times, and it can vacillate between the four sisters and any allocation within. When the CTI dictates there's a cyclical shift to a growth phase or a shift to a decline phase, and we can take advantage of both those, the up moves and the down moves in the market. So zooming in on this one, I'll go ahead and show you. When I say high octane, I'm not really kidding around. Since the inception of 2000, you can see there's a 664% return. And again, that goes back to the fact that we can catch the growth phases and the cyclical down phases with the change in our indicator. As far as drawdowns is concerned, we allow the portfolio to experience anywhere between 6 to 12% drawdowns to enable us to capture the bulk of those growth phases and those declining phases. So again, it's not something that's going to, we're not going to be changing on a dime with this portfolio. But the key is we capture these longer term shifts, and we're able to capture the meat of the move. So there's a little bit of to understand about that. So that is, and then here's back on the back page just some things about how that portfolio is exposed. So let's go ahead and wrap this up.
Rocket, Rocket, I was going to say, this is Josh Asher. I think one of the most important things, especially with big Pulse in particular, is to just point out to everybody. Obviously, we started trading these portfolios live at the beginning of this year. And if you look at the current metrics of those portfolios based on this year, and then you go back through to the model results, obviously being the fact that we're a quantitative shop, the dilution in there is very, very minimal. And so I know, and I do agree with the fact that I've never seen a bad back test, and it's kind of a joke in the industry, but when you can eliminate that subjectivity like we can, I think it helps a little bit. But also at the same time, I think it's important to point out to folks that, kind of like Kevin mentioned, this market, with this QE fuel that we're pouring onto this thing, we really have no idea how much higher this thing could go. And, it is that kind of bull market wall of worry that people are worried about, and instead of trying to watch CNBC every day and pinpoint and figuring out from a subjective point exactly what's going to happen or what the next big fundamental or geopolitical event's going to be, I think from a technical and tactical and more quantitative standpoint, to just have your hand on that parachute cord and be able to pull it when that happens. I think our portfolios do it well. What was, and I don't remember off the top of my head, maybe you do, but I think Pulse in 2008, do you remember exactly when that triggered and decided to go short?
I'd have to pull up the exact date. I think it was.
Okay.
Yeah, I don't want to speak. I don't want to give you incorrect data here.
Okay.
I think it was
Yeah, it's
later
not a big
in
deal.
2000. Yeah. If anybody has a question
Because
on that,
I
I can
know-
get that date. But
I know in January of 2008, in our life portfolio that we were running at the time, the long-only growth portfolio, we went 100% into cash in January. We began moving in November of 07, and we ended up in January 100% in cash right before that move fell. And of course, that was a life portfolio. We limited our investors' losses to, I think, 0.8% in 2008. But like you were mentioning, Pulse itself ended up going short. And then in our income portfolio, BIG, we would have actually pulled out a piece of that pie and hedged it up to where we were basically a beta neutral. And the same thing would have happened in Sage. Is that correct?
right. It's exactly right. Yeah, I mean, that's just, thanks for touching on that. I think that just hits on the point that, all of our portfolios, whether they take inverse exposures to the market like in Pulse to take advantage of those down moves, they all are able to get out of the way of those pending drawdowns. And again, it goes back to the one underlying our CTI indicator of the proprietary algo that really tells us when those shifts are occurring and to allocate appropriately. So I think that's a good clarification you made there.
All right, cool. Let's see if anybody has any questions. We've got, I think Kevin is still on here with us. And then, of course, we got Rocket and myself. So if anybody has any questions, you guys can go ahead and type a few in. And I see somebody actually typed in a little bit. Looks like somebody piqued their interest about the long-only growth portfolio. I'll just clarify that a little bit. We don't run that portfolio anymore. It was a portfolio that we ran with our previous firm before we lifted out to begin this very specific direction of offering ETF managed portfolios to advisors and institutions. But in the period, and of course these portfolios are really just the evolution of that long-only portfolio. Of course, the long-only portfolio was the individual stock and equity portfolio that would go back into cash during the 2000s and 2008, if you would. But from 2001 to 2011, so in a 10-year period of time, we were able to outperform the S&P 500 by 104%, and we did that with about a third of the volatility of the stock of the S&P 500. And of course, a big part of that was in 2008, we were able to sidestep that and keep our clients' losses to right around 1% in 08. So to answer your question, we don't actually currently still run that. We have built these three separate ETF-specific portfolios, which we really think is, helps do a much better job of decreasing some of the risk in the marketplace. Obviously, that's a huge concern for everybody right now. So hopefully that answers that question. And let me see here. Does anybody else have any questions that you'd like to ask? Kevin, the chief strategist of Tesseract, or Rocket, our portfolio manager with TAM Portfolios, in relation to really any of the portfolios, or just in general, kind of our outlook on the markets, or we'll go ahead and read it for you, and then you can kind of take it over, Kev, if you're over there. But it says, do you still see the secular bear market continuing for several years? And obviously that, Walter, just to preface that, I don't know if you've read our theory, the 100-year market theory, or not, but I think Kev could give you a very good explanation of that. And, you could also see that in some of the white papers that we actually have on our website right now that you can download for free. But I will turn that over to Kev right now. And James, I do see your question. We'll get to it in a minute.
So yeah, let's reiterate Walter's question. He was mentioning, do we see ourselves in this secular consolidation, or what he's calling the secular bear market, for an extended period of time? So I'm going to answer it kind of in two ways. Not to be indirect, but I'm going to be indirect. So the first way is this. There are certain metrics in which you can look at to understand the length and the longevity of a secular bear market. There are steps that you can take to understand where you are in the process of a secular bear market. In 2003, we penned a piece, and it came out, the 100-year market theory, which really was the first theory ever to come out and understand what a secular consolidation in the U.S. marketplace even was. And we believe that we were entering into the fourth, or we did have already entered into the fourth secular consolidation of this century. And as such, as we finished, the conclusion and the hypothesis was that the market would channel sideways for anywhere in between 16 to 18 years, starting in the year 2000. So if you look at the data going back when we first originated the theory in 2003, I would tell you that we were going into 2016 to 2018, beginning with the first, the break of the greatest bull market ever in history from 82 to 2000. And once we entered that channel, we were going to see massive vacillations in that. And then in 2007, we came out with a rendition of the theory. And the rendition of the theory talked about how you measure what happens in the cyclical moves, the business cycle moves of the market within that secular channel. And this theory that is coming out, the book that will be coming out, as Josh mentioned, he mentioned by January 15th, is really the final summation of the 100-year market theory and where it's all come from and where it is going and how it was developed. But what it also does is it draws in specifically how those measured moves are made. And the greatest thing that we've come up with, and not go into too long of a dissertation because I'm already doing it, but the point is that we believe that the halfway mark was the Great Recession bottom for two reasons, mainly because the largest recession that you see within the secular channel, if you look at all the secular channels going all the way back in history, whether it's World War I or whether it's World War II, or whether it was the 73-74 oil embargo, or it was the debacle that we saw, the financial debacle or the real estate debacle, whichever you want to call it, marked the midway point, which puts us right on task into the year 2018. So the big question that you should answer that you haven't, and I'm going to go ahead and ask it for you, and that is, well, we're above the secular channel highs. If so, then doesn't that mean that we're going into the new secular bull? So at this point, it's unknown, and I would have to say that, you know, my opinion of what that means is really not valid in the fact that, well, if it's here, we're going to take advantage of the run. The point that I will make, and to answer your question, is that if the Fed tapering stops, there is so much economic turmoil and cracks in the foundation that we will re-enter this channel and probably turn sideways for approximately the next, well, let's just say 3 to 4, if not even more years, until you do get that waning, because we have not yet waned off the excesses that have been built up over the 1982 to the year 2000 that we've seen. Even the PE valuations, the Tobin Q, whatever you look at as the metrics on a long-term basis, we haven't waned it. And the other thing is you really haven't waned it on a behavioral level yet either. I mean, the paradigm shift of the population now, as you can see the frothiness, if you will, in the market today, that greed factor is still coming back in. People are afraid of missing out. Our portfolio, which Rocket didn't mention, and I'll bring up to you now, his portfolio, Sage, saw after the Fed 22nd meeting that the risk was excruciatingly high in the market, and he trimmed back his portfolio to about a 40% exposure. And then in October, when we saw the fact that nobody really cared that they shut the government down and there was no headline risk going into the remainder of the year, he readjusted his portfolio in Sage to be 100% invested, because he looked at that exposure level and saying, well, the risk reward is too perfect, so let's take a ride along the train. Hence my comment earlier is the wind beneath our wings. So I know that I didn't answer the question directly, and Josh will probably kick me in the teeth because I'm talking too long, but my point I'm trying to make to you is that we will ride this wave until the wave ends. And as such, it's hard to placate an answer to you that will say, well, I believe that it's going to end tomorrow, or we're going into a cyclical bull market tomorrow, or I'm sorry, a secular bull market tomorrow. There will have to be a lot of changes that would have to occur for another 20-year move in the marketplace to happen. So my belief is that tapering will shut off or start to come in probably in 2014 and finish up in 2015. If that happens to be the case, the market will take that, and they'll stop looking at the earnings on the bottom line and really start looking at the facts of the unemployment and of the revenue numbers, plus the other ancillary things that are coming into play. And when that does happen and reality sets in, this market should channel sideways in a large range, and I'm talking anywhere from between 18 to 30% vacillations on an every 8 to 18-month period of time, probably going forward for the next 4 years. Now, that's an educated guess, and I wouldn't write that down, and I wouldn't go to Vegas and bet on it. But I think that if you were to look at the landscape in realistic terms, that's probably what's going to happen. So the big question is, when will the Fed stop? Because when the money stops, look, this is musical chairs. Don't be the guy left without a chair.
Right, and I think just to kind of sum that up, I think, you know, the most important part, Kev, and let me know if you disagree, but, you know, obviously, you know, trying to pull out a crystal ball and say that this is what's going to happen in the next 5 years is very difficult. And, of course, you know, a lot of people lose their jobs on the trading floor doing that. But at the end of the day, if you can quantify it and you have kind of that North Star, that investment philosophy like we've done by quantifying over 115 years worth of data, you know, it helps to really just be nimble and to be patient and, you know, to not be headline driven and to be unsystematic or systematic with things. And I think that's the bigger question that I think investors and I think, James, I think I remember speaking to you, if I'm not correct, you're over on the East Coast in Florida, but, you know, I think that's what advisors, I think that's why you've seen a huge move into the tactically managed portfolio space, because they don't know what this market's going to do, but you need somebody that can take advantage of it whenever it does whatever it's going to do. So the other question that we have is from James here is, and Kev, I don't know if you want to take it or Rocket, you do, but just what's the general view of commodities in general? And I don't know if they're talking about just a high-level view on commodities. James, if you want to expand on that or not, but Kev or Rocket, I guess I'll turn that over to you guys.
Yeah, I can take that. So it's obviously a very broad-based question, right? What is the view on commodities? If you look at the CRB index, a lot of people know that the CRB index is made up of 17 different commodities, of which half of those are soft. Those are your grains, your pork bellies, so forth and so on, and then the remainder are your hards or your consumables or your energy-based commodities. And so one of the things that you have to look at on the commodity space, and if we're talking about your consumable or soft commodities, is are we going to go into a grain or a pork belly inflation or a food inflation environment like we were skating on 18 months ago? And that's really difficult to tell at this point in time, because a lot of that, as everybody knows, is driven by weather. There's some issues with the cattle, and there's issues with how there's a lot of cattle that got brought to slaughter, and then there's going to be a beef shortage going forward this year. So, I mean, there's a lot of things that have to play into that, and obviously, as everybody knows, the cost of grain is a big factor. So that's a space that I really, other than what I've just said, I really can't answer. So if you look at the other commodities, of which you're probably talking about energy and precious metals. So those are the two hottest topics right now. So let's talk about the energy space already. Rocket touched on it earlier. We as a firm, as me as a chief strategist at Tesseract Asset Management, I actually believe where oil is and also nat gas. I don't believe in nat gas as a commodity yet to be able to take off and be able to provide an investor with a solid non-volatile type of return. So I'm not recommending that. I don't think it's an area where you can play. However, the movement and the progression that you're seeing in the energy space is greater than you've ever seen in the last 50 years, and that's based on, again, what Rocket was touching about, and that's, you know, the shale production as well as the nat gas that is now being delivered. So pipelines is a great area, and that's why we're in the MLPs, because you get paid as anything goes through the pipe, and you're not subjected to the actual price of the commodity. And let's touch on oil. We actually own a position, or Rocket owns a position in USO, which is in Sage, and this position we believe in wholeheartedly. Now, we picked it up around 100, and it brought down to around 94. I think trading 95, 95.5 today. And I don't mind that kind of volatility, because we believe that oil could and should be somewhere in the area of 140 again within the next 18 months or so. Now, if that doesn't happen, we will be more than happy to move out of that space and rearrange, but we're starting to see some of the underlying foundations. Now, I know that there's a lot of talk on the street right now. There's a lot of people that are shorting oil or getting out of the commodity. I think that's fine. I don't actually have a problem with it. When everyone's in one side of the trade, I'd rather take the other. but what you're seeing is that oil has been in a sideways consolidation mode for nearly 2.5 years right now. It had a nice massive move and a breakout because of some economic things that have transpired, and right now it's settled back down into its base. So I believe that its next move should shoot it past that 110 mark of what we're looking for. If we don't get that in the next 6 months, as again Rocket mentioned, he'll probably end up switching the portfolio to something that, if it is in the energy space, we'll still be able to take advantage of it. The last and final comment that I'll give you is on gold, and it's a very touchy subject because people look at gold as a commodity, people look at gold as a currency, people look at gold as a hedge. I mean, it's a matter of how you look at it, of how this question needs to be answered for you. So I'm just going to give you a broad base on where I think the price is going. And I will try not to play into too much of an opinion on why I think it's going there other than it's technical. When gold broke the 1,500 level after the consolidation from 19 to 1,500 for nearly 18 months and it broke down, we believed that just technically based on a measured move and where this could go and the type of money that started exiting on the gold basis, and I'm talking money on a global basis, we believe there's a possibility that gold could get down into the 1,100 level. Now, with that being said, I'm not saying there's anything wrong with gold. I actually believe that on a long-term basis. However, I think the volatility metrics within gold at this particular moment in time is too high to be able to hold on. I think there's better opportunities. I personally, just to qualify, I own physical gold myself. I also own gold outside of that. So I do like it. And I like it for, an inflation hedge. I like it because we could have a dollar situation. I like it because you don't know where interest rates are going to go. In the interim, though, as an investment, if I was to put it into a portfolio, I would need to see much more strength and stability in the ETF itself before I would have had any interest in it. So hopefully that answered your question.
All right, cool. Looks like we've gone a little bit over. We'll go one more round. If anybody has any questions, you can type them in. In the meantime, again, we really appreciate your guys' attendance to these. This is the first one. This is the first of a series. We're going to be doing them monthly. They will be every month on the second Thursday of the month, I believe. And you'll get an email from us talking about it. But any suggestions you have, let us know. We hope to make this. We want to make this as informative as possible. Obviously, the first couple ones we think we know what's informative, so we put together a presentation and give it. But if you guys have any suggestions, obviously we'd really appreciate hearing from you. So you can type those in, and if we don't see any questions come up, I guess we'll go ahead and close this thing down. But thanks for everybody's time, and I guess we'll see you guys next month.